welcome and good morning, good afternoon, and good evening to everyone that's connecting and joining us today. My name is Temidayo, Adebayo, and I'm going to be your host today in this Fireside chat with Mr. Bruno. Wenn. I'll be joining us in a few minutes. Today's topic is going to be funding African SMEs. SME stands for small, medium-sized enterprises, and we'll be particularly looking at the role of the DFIs, which is developmental financial institutions, and other developmental agencies in the funding of African SMEs. So you're welcome. It's going to be an interesting power packed. Mr. Bruno Wenn, who will be joining us shortly, is the current chairman. Welcome on board, Mr. Bruno.
Hi.
How are you doing?
Tony. Good to see you.
Good to see you too. It's always, an interesting conversation together when we talk about the DFIs and especially how the linkages between the African communities and the role the DFI plays. So, welcome on board. I would, let you introduce yourself a little bit. Mr. Bruno, like I said, is the chairman of the European Developmental Financial Institution. So, Mr. Bruno, please introduce yourself to the audience, and we could start the chat.
Okay. So welcome everybody who is joining in. Good morning, good afternoon, good evening. So my name is Bruno Wenn. I'm the chairman of the European Development Finance Institute. I will talk a little bit about them later. So I'm an old guy of German European International Development Corporation. I'm in this business since more than 40 years. And after 37 years spent with KfW Development Bank, which is the largest, or the KfW banking group, which is the largest promotional bank in Germany, and formerly head of the DEG, which is the German Development Finance Institute. I retired, and since then I'm very much still engaged in German, European, and development finance. And the European Development Finance Institute, that's a group of 15 European Development Finance Institutes created in 1992. So we started with 3 European Development Finance Institutes, institutions like CDC, the Commonwealth Development Corporation, created already back in 1947. And the DEG created in 1962, and today we have 15. Out of them, the youngest is SOFIT in Lisbon, and the Austrian European Development Finance Institute, and since many years we have done our business to promote the private sector in developing countries, and since the Sustainable Development Goals put a special focus on the need of the private sector and to promote the private sector much more, out of the sudden we are now on the radar of most of the policy decision makers, and since then we are growing extremely fast, and on the average about 10 to 15% per annum. Which reflects the growing relevance and significance of the private sector. And as of today, we have a combined portfolio of $50 billion. 1/3 is invested in Africa. And when I say invested, I mean invested. So we are taking a lot of risk. And this is actually what is our role and what our owners and shareholders asking us to do, to go to the most difficult places of the world and to show that it's possible to invest there on a profitable basis, and at the same time also align with sustainable development goals, align with prudent environmental and social and government standards, and also being aligned with the Paris Agreement.
Great. Wow. Look, I remember my first encounter with Mr. Bruno Wenn when he was still the chairman of DEG on a diligence trip in the I don't know if I could call it in the middle of nowhere in DR Congo.
It was in the middle of nowhere. Huh? 2,500 kilometers away from the capital. And stuck for many hours on the river in a small boat.
Yeah, I still remember that clearly. And what fascinates me about the role of the DFIs, and you mentioned the amount of money invested in the market. And even though a majority of us may not know, somebody, there's a question that says, what role do you play as chairman of EDFI? So I'll let you take that.
Yeah, okay. I as a chairman, I do what all the chairmen are doing. So I share a supervisory board with 5 colleagues of mine representing the members, and we jointly oversee the activities of the secretariat, which has now 8 staff members plus a director general.
Okay.
And we also oversee our subsidiary that we have founded in 2016, which provides blended market facilities financed by the European Commission. So that's, for example, for electrify, that's for electricity sector, and then for agrify, which is for the agriculture sector, and the forestry sector, where we are able to provide technical assistance, but also equity, long-term loans for businesses which are in the startup phase. So with high risk, and by doing that, we help them to develop at a level that then our members can take over and provide then the usual funding.
Great.
So this is usually what a chairman is doing, and then the chairman is also representing then the association. And since many years, we are doing a lot of advocacy role, so promoting very much the role of the private sector, especially within the European Union, as part of the Team Europe approach, and also with my colleagues in the US, that's the US Development Finance Corporation, in Canada with our friends from FinDev, and also with our colleagues from the IFC and all the other international and bilateral development finance institutes. We are in regular contacts, and we are trying to push forward the agenda that the private sector is key, and that the policymakers have to do a lot in order to help us to fulfill our role.
Wow, great. So one thing that I'm curious to really get to know, EDFI actually has its own funding power. So yeah, Bruno mentioned electrify and agrify and the forest. If I'm correct, the new one that is a forest. What do you call it again?
No, it's agrify. It's agriculture and forestry.
Okay, agriculture and forestry. So by the way, for the audiences, EDFI also do provide direct funding from to specific sectors that that the electrify supports anything solar, and agrify, which is agriculture and forestry, support anything agriculture across the developing countries, not just only Africa, but any developing nations as well. And they are very active in this game, and we are very and so they've put in together the very best to really help help the other developing countries to achieve and set up the examples for the rest of the DFIs. Now, one of the few things that as a young fund manager, or aspiring fund manager, one of the few things is another question just popped in and said, what role the DFI plays in funding African SMEs? Now, before you answer that question, and this just a chit chat that you and I have had a long time, over the course of the years, on when it comes to funding. You mentioned about 50 billion has been invested in the African markets. Now, the play now, and you mentioned something again that's about your mandate is to take risk that the private sectors or the typical commercial investor would not take. Now, I believe that includes anchoring a first-time fund manager. That includes anchoring, not waiting for 3-4 years before you anchor, or waiting for somebody else to come in before you come in. And I would say if you're taking more risk, not saying going for a fund that is in its 4-5 years of fortified fund. So you see, we've seen that trend a lot, where you have a fund 5 and you see the DFI is playing an active role. They play in fund 1, in any fund 1, then they play in fund 3, fund 4, and fund 5 companies around developing countries. So when you answer this question, put that into context. So how do we now balance the play? You're supposed to take more risk, but in the reality sense of it, how do we foster that? I'll let our audience give them some context on why does it take so long for the DFIs to really do funding, and when they're funding African businesses?
Yeah, okay. Let's answer this question first, and then I go to the SME sector.
Okay.
No, you are perfectly right. Sometimes it takes a little bit longer, and I'm very much concerned that it always takes longer than anticipated. That's part of what I said, that we are now on the radar of a lot of policymakers, and they are asking us to do a lot. So they always put a lot of horizontal conditions to what we should achieve. So we have to take care for human rights. We have to take care for proper environmental and social concerns. We have to take care for governance issues, etc., etc. And this has a tremendous cost in terms of due diligence. And this is why then at the end, when it comes to first fund manager, our members would like to be pretty sure that the first-time fund manager has the systems in place in terms of environmental, social, governance, human rights issues, etc., that the DFIs are responsible for against their shareholders. And at the same time, they would like to see that they have the necessary capacity. So the track record of people. So if a first-time fund manager recruits all the necessary capacity and installs all the necessary systems in place, then it reduces dramatically then the time for due diligence. This is an issue that we have to take care for. So with regards to small and medium-sized enterprises, yes, the small and medium-sized enterprises are the backbone of all our societies and economies. That's not only in developing countries; it's the same also in all developed countries. The same in my home country, Germany. It's the small and medium-sized enterprises who provide most of the jobs, and creating this kind of environment. This is crucial in order also to achieve the sustainable development goals. So when we look then to Africa, yes, DFIs play a crucial role in funding African SMEs, because we are doing it through direct funding of small and medium-sized enterprises. This usually cannot be done out of our capitals where our members have their seat. That's obvious. But this is why then we need intermediaries who can do that. That may be funds who are providing debt financing, or funds who are providing equity to small and medium-sized enterprises, or, which is usually the case, we are looking to financial institutions. That may be microfinance institutions, but it may be also commercial banks.
Okay.
The crucial thing is that in doing that, on the fund basis, on the financial institutions, rely on the intermediaries. And we have to understand how these intermediaries function, whether they actually have an appetite to go for the small and medium-sized enterprises. And if I look to the commercial banks in Africa, they almost do the same than their colleagues in developed countries. They take care for the larger companies, the larger corporates, because it's much more easier. They know their business model. They have a lot of information about their business model. They in terms of transaction costs are lower, risk are lower, and this is why in developed countries and in developing countries you always face the same problem: how to get access to finance for the small and medium-sized enterprises. If I listen to African small and medium-sized enterprises, they're always complaining about this missing access It's more or less the same that when I listen to German, small and medium-sized enterprises. This is why at the end, the question is how to find the right intermediaries who have an access, who have an understanding, who have the right credit technique, etc., etc.
Now, you mentioned how to find the right intermediaries. Now, when you look at legacy funds that are now moving towards efficiencies in their model of business, the first-time fund managers are the ones that specifically focusing on SMEs across the African market or any developing market, for instance. Now, the caveat to encourage more fund-time managers, especially the costs to create all those things that you mentioned. Now, imagine a young fund manager coming out of an existing fund or an existing company that wants to that identified a niche and have built together a strategic model to really address that particular need. Now, the bond rates for that individual to put together an office, a team, and all those things put together, and still being dragged along for a quite number of, most of the time, the DFIs will say, go get somebody to come in before we come in. This is what I've experienced in my own short time of raising capital. But the reality is you expect so much from a guy that is trying, just like just like our small business. The first-time managers are also small business in their own phases, but the actual cost, the barrier to entry into that space that will actually solve this problem for us, in which most developed countries don't face, is why I'm redirecting, why I'm trying to understand clearly. Yes, there's this huge risk matrix structure designed to support small businesses in developing countries, not just only Africa. We realize that most of these businesses are very, very high risk, not because of anything else, but because of the regions that they are. So how would a fund manager be encouraged when knowing the cost to really, really start up a fund relatively to success in actually raising the fund? It's where the line, is a conversation that that you and I have had a long time about. When you start a venture and you expect to have all this infrastructure in place, and many of the fund managers bootstrap to put their stuff together, then 3-4 years down the line, they're still struggling to get first close. The companies that they've tried, as they are directly impacted, the small business that they've had in their pipeline are also being directly impacted. So therefore, dragging the old developmental phase that the word developmental financial institution really, really stand for. Now, obviously, what are the kind of encouragements with the new pressure coming in from the policymakers now, from all the major stakeholders or shareholders in those developmental institutions, what kind of education, what kind of tweak, you want to spend $100 million in a week, in a year into a fund, but you have less than 10 people in the, let's say, BIO office in Brussels, or what the reality is, it is, like you mentioned, it is easier for them to go into a second or third fund that already had all this infrastructure. They won't need to do too much diligence than to go into a guy that is just starting up. So it's something that it's a matrix or a match that really, really marvels me all the time. You're trying to match this to this, and it's just a narrative. It's something. And I would like to, anybody in the audience that I want to ask questions, please send your questions, and we'll be glad to answer you. We're just having a chat on how the frustration has come up in building a market where the type of returns you expect and the type of I don't know, I lost the thought now, but the type of sophistication you need in that market is not there, and it's not there, or it's going to take a while to build. In the recent years, in the recent few months, we started a series on African commercial free trade zone a while ago, and the conversation we've been having is, if we identify that there is a shortage there's a shortage of a particular commodity in one African nation, and there's surplus in the other African nation, how can we leverage the developmental institutions to help us enforce, or to help us promote, or to help us support that gap in commercial funding or risk? The banks are not going to take the type of risk EDFI would take. The banks would come for you for guarantees, so that when they take those risks, you could build them out. So, when the Kenyan government is saying is lending from the local banks, competing with the small businesses that are trying to lend from the same bank, the banks would, by default, if you're a smart CEO or any CFO, you know that it's less risky for me to lend to the government than to lend to a small business. So, I think this will lead us to my next activity when it comes to. You want to say something? Go on, Bruno.
No, but nevertheless, I would not buy in this argument that for banks it's almost more profitable to buy T-bills. I think what we as EDFI are pushing banks to consider to change the way in which they are dealing with small and medium-sized enterprises. Okay. So what I have observed is that a lot of commercial banks use the same credit technology they're using for corporates, also for micro and small and medium-sized enterprises. And that's, to some extent, the result is then extremely high costs. And then they're always complaining that, to some extent, the small and medium-sized enterprises are not capable of providing the right statements, financial statements that the banks need, that they are not bankable in their sense. And I think that's completely wrong. And if this is the case, then we need also to educate them. But you have to change also the way in which we are dealing with small and medium-sized enterprises. And there is a good example. The microfinance banks, they are doing excellent better, and they have created a completely new credit technology, which is called relation banking. So they're going to the small and medium-sized enterprises, and they are trying to better understand the character and also the business model, and then to make a judgment. And that's completely different than simply asking for collaterals. And then if people are not able to provide collateral, then it's out. So the different thing is then with funds, and what you mentioned with funds. And there is no way out. That fund is extremely risky. And if you are asking for 100 million, then you have also to provide evidence that you are capable to use these 100 million in a way that the risks are being justified. And to tell you a story, that our shareholders and most of the policymakers, they do not like these kind of intermediaries, because they always have questions about fund managers. They always have questions about financial institutions, whether they do the right thing and whether they are aligned with the development mandate of the Development Finance Institute. So this at the end also explains why we as Development Finance Institute always have to be pretty sure that the people that we are working with in the financial institutions, or maybe in the fund business, that these people are capable to use the money and to achieve at the same time also the development impact that we are looking for.
Okay.
So this is why at the end, trying to figure out what are the right institutions, and are these institutions maybe financial intermediaries or maybe fund managers, whether they have the outreach, whether they are capable also to assist their clients in crisis, etc., etc. That's key. And this has much to do with the competence, that has much to do with the track record, because the track record is the easiest way where you can make a judgment whether the competence is in place, whether there are capabilities to assess, to help clients in need, etc., etc., and to build up a pipeline which at the end also provides the financial returns that the fund is looking for, and also the development impact that the fund is looking for.
Okay. So yeah, there's a question from the audience that says, what steps should DFI take to improve their ability to design approaches that best enable them to provide services to marginalized communities? So,
to be very honest, that's not our job. Because marginalized communities, they are better served by the donors and the development agencies. Because the marginalized communities, from a purely point of view as a responsible financier, I would be very hesitating to provide them with some kind of long-term loans, and especially long-term loans which are then being which are repayable in foreign exchange. I think this is not the right way.
Agreed.
But what can be done, and what is one of the core elements of, for example, Electrify, what I have mentioned is support to a lot of small and medium-sized enterprises in Africa that provide, for example, electricity supply, water supply to communities. So off-grid solutions in a way that is affordable and in a way that is sustainable, because it's being done on an entrepreneurial basis. So where services are being sold to communities, and through the revenue cash flow, then they pay back the financing, but also take care for operation and maintenance. And that works perfectly fine, no?
Yes. So you're saying that for the marginalized communities, it is more of a donor type funding than a developmental financial type funding.
Yeah, because once again, from a viewpoint of a responsible financier, I would be very hesitating to provide them with any kind of foreign exchange-based loans, which is usually the case when DFIs are financing something, or development banks are financing something. I think this is not the right approach.
So then what role, or how would, have the DFIs worked or been partnered with donor funders to actually build or promote sustainable development goals in those marginalized communities? Now, they are called marginalized communities primarily because they've been marginalized from, there's a systemic type of marginalization that's occurred, not by their doing, but by default of, whichever race, gender, whatever it is that they stand for. So marginalized communities can be women communities, for instance. Marginalized communities can be can be the underserved communities in most developing countries, or even in developed countries. Now we've seen that play out, and marginalization doesn't actually is not just in the small, medium sizes. They've been marginalized when it comes to environmental policies. You've noticed, you've seen in some demographics or some geographical locations where environmental policies is more favorable, while it's less favorable to the other side. So by default, the type of regulatory approach or the type of policy enforcement is different in one community than the other community, primarily because of the power, or because of that same marginalization. So if I echo you correctly, what they need is more of a donor type, government type support. Then the DFIs can come in when there's a clear path to really providing a long-term financial instrument for them.
Absolutely. And And I have understood marginalized in the sense that they are financially marginalized. So, and if they are financially marginalized, then they do not have the financial capability to pay back any kind of loans. And what you mentioned with the marginalized communities, in the sense that they are women, that they are young people, etc., and they need also access to financing. Yes, our members have done a great job in creating 2x challenge as part of the G7 policy to promote much more women development. And the good thing is that now gender lens financing is part of the mainstreaming activities of all the DFIs, and they have committed much more than originally intended to do so. And now within the European context, we are very much looking forward, and part of the European initiative to provide support for young entrepreneurs in the context of Africa, because that touches a little bit of what you mentioned with the first fund managers, that young entrepreneurs, they do not have a track record, they do not have something they can offer as securities and collaterals to the banks, and this is why banks are very much hesitating to provide any kind of funding to them. And and we can play a crucial role by helping the financial institution to cover this kind of risk, and at the same time also helping them through technical assistance, so that the staff in the deal teams, in the front office, that they have a better understanding in terms of gender lens and in terms of the needs of the young people. And this is why technical assistance is crucial. And we had the other week we had a webinar with a lot of financial institutions from Africa. This was one of the outcomes, that technical assistance is needed in order to help the institutions and their staff, but also to help the clients to become more resilient. And I think this is also what is what our members in EDFI experience, that as part of the COVID-19 crisis, they have tremendously increased the technical assistance to the clients, to help clients to adapt their business model to the disruption in the value chain, and to help them to make their business model much more resilient. And this is why, at the end, although we all started with, let me say, a lot of concerns about the effect of COVID-19 on the portfolio of our members, at the end it turned out that the clients have been much more resilient than anticipated, and that's great. Especially in the context of Africa, they have been much more resilient than in other developing regions. That's good.
Before I go to the next question, I just wanted to had a follow up to that question in regards to, so when so the African continent and most developing regions also have their own local DFIs. And how has the developed DFIs helped in promoting active local funding? Now, when you mentioned a lot about foreign currency within the local market, and I believe we have ECOWAS, we have African Development Bank, AFDB, we have AFC, we have the African Trade, and now there's a new fund called the African Guaranteed Fund, if I'm correct in the making. Now, how much of a collaborative effort, or how much of a joint venture type of work, since you've been around longer than most of this development DFIs within the African market, to actually promote and help them, build up, wrap up effectively, where they take, they are the frontliners, of of this of this new age of literally, I believe that Africa needs a lot of fund managers now for us to achieve the type of small business funding growth that we are envisioning. Now we've been hearing Africa is going to grow by 50 million. Africa has been growing forever, but the people that are actually doing the work are not growing. We need Africa need more fund managers, whether male, whether female, whichever you could find, because they are the ones that will be in the local markets. Now, but the first thing is that, the first question is always, you have to first of all look inward. So, what are the roles the EDFI is playing to ensure that the capability that you've developed over time is being translated effectively within the African DFIs?
No, that's indeed, to me, that's music in my ear. That because since many years, I'm advocating that the best way for Africa is not always to look at whether they can get access to finance of OECD countries in Europe or US or elsewhere, but to look at their own financial sources and trying to make these resources much more available for development. Having said that, what we are doing is last year we have created with the other public development banks the Finance in Common, which is now a network of more than 510 public development banks and the development finance institutes. And the focus is exactly on these regional DFIs, because for reasons, for many reasons, they have been neglected for a lot of years, and they could play a very crucial role. And this is what we are trying to do. And in order to show you what happened last year at the Finance in Common Summit, the first one that we had in Paris, very recently we had the second one in Rome. We, as European Development Finance Institutes, together with our friends in US and Canada, we have created a coalition for micro, small and medium-sized enterprises in Africa. And the African Development Bank has joined the coalition. The BAYI, the Bank of Western Africa, that's a development bank, and then also the Trade Development Bank in Nairobi. They have joined this coalition, and we have committed more than 4 billion additional funding for small and medium-sized enterprises in the African context, plus technical assistance. And this is what we are trying to do. And I'm very optimistic that we will reach our commitment by the end of this year. The second thing that you have mentioned is a fund. In order to do that, we need much more, because we need to create a culture of equity finance in the context of Africa. And this is not only a question then on funds, but it's also the question on in how far governments can change the regulatory environment so that it's easy to establish funds in Africa and to work out of Africa and to tap in African financial resources. For example, the insurance companies, the pension funds. Why not using this capital also for the development in Africa? And this is my personal vision, what I would like to see at the end, that we achieve something completely different than simply always looking at OECD funding and looking at in how far we can use African financial resources, and they are there, but not yet being used for development. So Temi? Temi, I think I have lost you. So, but I can answer some of the questions. How do DFIs measure development returns to investment? This is a very interesting topic. We are working on how to measure and to report back on impacts. That's easy to say, but more difficult to implement. Why? Because we have to harmonize the way in which we are doing it. And this is why we in the European Development Finance Institute, 2 years ago, we embarked on a very bold initiative that's called Harmonization Initiative, because we are harmonizing these kind of measurements, and we have started with 3 out of the 17 Sustainable Development Goals. So I'm happy to report back that we have finished the technical work. We have defined the metrics, how to measure, for example, jobs. How to measure the impact on gender, how to measure the impact on the climate, because once again, it's easy to say, but difficult then if you do it on a very precise and technical level. For example, jobs. What kind of jobs we are looking for? Temporary jobs, permanently jobs. So what kind of quality we should look at jobs, also whether the jobs are being created in an environment that is aligned with the core principles of the International Labour Organization, etc., etc. So, and this is what we have done. But it's not sufficient because that's only us, the EDFI group. This is why we have reached out. So we have built an alliance with our colleagues from the IFC, with the colleagues of GIN and others, and so that we are trying to harmonize the many, many metrics that are already available in a way that we have industry-wide standards. That's what we are looking for. And my personal vision is that at the end, we would have a system of measurement and reporting which is being part of the international financial reporting standards, so that we have a full package where we report everybody, all the corporates, all the investors are reporting back on their financial returns and on their development returns. But this requires much more efforts and especially also a much broader consensus among all within the industry that is the way forward. And I plead to the policymakers, because the policymakers can steer the debate and can create the environment that everybody is in line with what we are trying to do. But development returns to investment, that's part of the Sustainable Development Goals, because at the end, the question is whether we achieve high financial returns, but the question is, do we achieve sustainable development impacts?
Back, I lost the connection for a few minutes.
No, so sorry, but I have already started then to answer some of the questions. Huh? Should I continue?
Thank you very much. Before we answer the next question, there's one question that I wanted to bring up when you mentioned the coalition that you had and the allocation for small, medium-sized enterprises that's been designed for Africa. That's the Europeans and the European Union, the DFIs are put together particularly to help funds. Now, my question is, now the allocation is the allocation being managed by African Development Bank, an African DFI, or is it managed by the other DFIs?
The coalition, no, the coalition that I have mentioned, each of the partners manage their own contribution.
Okay, so now if they manage their own contribution, so now you mean, so whatever, so if there's any allocation that has been allocated on a concession basis, so let's say the World Bank is giving is raising 1 billion for Africa small business. Has this been when the World Bank want to hire or want to identify who to manage that particular allocation? Is it being managed by African entities, or is it being managed by the DFIs, the European DFIs, or the global DFIs?
When the World Bank is providing money, the money is always going then to
I see.
No. That's when it's a World Bank, then it goes to governments.
Okay.
So the differentiation is always the public development banks. They always work with governments, and the development finance institutes. They're always working with the private sector.
Okay. The next question is, I think, if you could put it back, what are some of which I believe you've answered, but one of our audience wants to get a clearer understanding of what are some of the things that makes DFIs hesitant to commit to various countries in Africa significantly. So the word is significantly. So you're already making commitments. But
no, we are making commitments, and we would like to do much more. And yes, there are some reasons why we are hesitating. For example, there is much political pressure to go to some more difficult places in Africa. These are fragile countries. These are post-conflict countries. The difficulty that we as DFIs have is that we always work with an investor. So before I can go to invest in some of these fragile countries and post-conflict countries, I have to find an investor who is ready to invest a large part of the investment cost in one of these countries and taking the risk. So this is why we as European Development Finance Institutes, after a long debate, we have decided that it's not sufficient anymore simply to do deals, but we have to speak out. We have to increase our policy advocacy role. We have to work together with public development banks, with governments, in order to help them to create this environment, this business environment, which helps businesses to grow. That's a question of regulation. For example, since we have already talked on the power sector, in a lot of African countries, it's extremely difficult to finance renewable energies. If the renewable energy, if the power generated goes into a grid. So the private investor is selling to a public sector entity, which is financially not viable. So how you can assume that a private investor is coming in, putting a lot of funding into investment for the next 30 years without having any kind of guarantee that the public provider is paying the bill according to the power purchase agreement in time? So this is one of the key issues where we are calling then on the European Union, on the governments, to come out with a regulatory reform plus a guarantee agreement, which helps then the private investor to come in. So in this kind of business environment is needed. So for example, we as EDFI, we are working very closely together with the Clean Climate Financing Leadership. That's an initiative of all the big banks and insurance companies. And we have published policy guidelines to unlock private investment into the power sector, for example. So these are easily reforms. I know that for politicians it takes a lot of time to do that, but this is needed in order to get much more funding into it. So with this kind of let me say reforms, the markets are greater. At the same time, the risks are lower, and there is then an opportunity for private investors to come in. And if they are coming in, then we can, as DFIs, we can be of help.
There's a question from Stefan, and it said, can the speaker explain to us listening how much funding has gone from DFIs into the consumer food value chain?
I cannot give you the concrete figure, but I know that a lot of our members are financing that, and I have a lot of very good examples from my past time in DEG, where we have financed a lot of African entrepreneurs who are working with thousands of small businesses, buying their fruits and producing beverages for the local and for the regional market, and that, I think, it's tremendous development-oriented business opportunities, and there are much more, because this kind of, let me say, agribusiness, so producing for the local and regional market, there are great opportunities in the context of Africa, and even more if the policymakers in Africa succeed to implement the African Free Trade Agreement.
Okay. There's another question that says, the COVID-19 pandemic affected small businesses, SMEs, and most are responded to their immediate financial and operational needs. How have or are the DFIs shaping their policy response around the need for these SMEs, especially to provide financial and support to struggling businesses?
Exactly. This is why we have stepped up our efforts starting in March 2020, with a special focus on small and medium-sized enterprises in Africa. We have provided technical assistance to companies in need. We have provided liquidity, extra liquidity for companies in need, together with the European Investment Bank. For example, we have created a special COVID-19 window in one of the joint facilities that we have to take care for these additional financial needs. And COVID-19 was then also one of the motives why we have created this coalition for African micro, small and medium-sized enterprises that I have referred to last year in the Finance and Commons Summit in Paris. So, because we see there's a lot what needs to be done.
Okay. So the question now is, how easy is this program accessible to the small businesses, or are they going through another intermediaries to get access to it, or are they going directly to the to the DFIs, in their local offices? If you're in Nairobi, or if you're in Lagos or in Ghana, what?
No, it's usually they have to work with their local bank. And this is why, once again, because it's a local bank who is then using the funds. And this is why, once again, stress is a need also that intermediaries have to change the way they are dealing with micro and small and medium-sized enterprise. Because very recently I had exactly this kind of discussion, where I got a lot of complaints by small and medium-sized enterprises complaining to specific bank that they have difficulties to get access. So I called then the CAO, and the CAO also has then organized a meeting with the head of the different departments. And at the end, it turned out that they were simply complaining and saying, yes, we need... we see there is a need, but we do not get the information that we need. And then we had a debate: what kind of information they actually need in order to make an assessment whether they can provide a loan or not. And at the end, it was quite crucial that a lot of information they were requesting was already existing within the bank, but not known to the people who are processing the loan. And so some changes in the procedures would be necessary. And the second thing was that they simply can also help. their clients. Simply provide them with an app where they can also make then their financial statements. And then they can use the data also for monitoring, etc., etc. But at the end, it's also providing much more confidence in your client base.
Okay,
so a lot is needed.
So the challenge is not so the intermediaries in themselves need some technical assistance in understanding the type of information flow within their system. So that's one of the few conversations that we've had in the past, whereby we've spoken about the capital that is available within the countries and the regions where the small business size, where the small businesses are existing, but the challenges is them accessing from their local banks, their local DFIs, these funds. So these funds have, is sitting down right in the bank. But we had a conversation with the bank on trade-related financing, and it was amazing that most of the bank officials were comparing trade financing to foreign exchange. And so if somebody had come into your bank and saying, I have an off-taker agreement to supply XYZ thousand or million of this, and everything else is checked out, the bank official really don't know what a trade finance looks like. And we have identified that local banks have relationships with the DFIs. The DFIs are provided allocations to these local banks to provide access to some type of capital to small businesses to thrive. The problem, so I think how much more of technical assistance within the intermediaries is required, and how much more, how as the rollout to help this local intermediaries understand the type of structure or language when you're comparing a small business to a readily established multinational business. I think that is where the challenges that I've been hearing for the last for the last few minutes are. There's a question on the table that says, what does DFIs look for when considering SMEs to invest in? This is, I think Bruno's answered that question, but I'll let you take a strike at it already. He said, so let's assume you want to invest in a small business directly in Philippines or in Delhi or in Nairobi or in Kampala. What do you typically look at? I'll say from the risk point and from the return standpoint. So we're taking that from the risk angle. How much risk are you willing to take? Maybe, or how, what are the ticket sizes if the DFIs, which I believe, would invest in a small business in Africa?
I think what we are always looking at is a financial capability. Yeah? So is a business model structured in a way that the company can survive and that the company can achieve the financial returns that the investors are looking for. The second is whether the management has the capability to do that. The third is whether let me say there are market opportunities that maybe the management has not yet seen, and that could be achieved sometimes with very small investment. The fourth is whether the company is capable to comply with accepted international environmental standards. The same goes for social standards and then for governance standards.
Okay.
So it's usual. It's routine that within the due diligence there's also a check on whether their capability, whether their opportunities for energy efficiency. So sometimes there are only a few changes within the procedures, and sometimes a few investment needed in order to implement energy efficiency, which at the end will reduce the operating cost. So at the end, there are a lot of issues that have been dealt with. But to be very honest with you, the usual size that DFIs are looking for is around 3 to 5 million US dollars, because the transaction costs are extremely high. And this is why the need to go for intermediaries, may it be financial institutions or may it be funds that have the access, that have the capability, and where there is also readiness to do that on behalf of the DFIs. And I think this is the best way to do it.
Yes, we are right on the dot of the hour. So I would say thank you, Bruno. If you give us a final word, final word of encouragement to aspiring fund managers, male, female, in the African market, and small businesses, the final word to say, to wrap up this session, and we're looking forward to many more from it. But just to give us the final word and a word of encouragement to what the DFIs are doing, and how the DFIs are welcoming more pipelines of fund managers to come on. Where should they go to? How should they do this? And just your final words, and I'll just close us and just wrap us off.
No, Tammy, thank you very much for this encouraging 1 hour. No, I think you should proceed with your ideas and pushing forward with your business plans, because what I have not mentioned yet, that a lot of our members have also special programs where they can provide technical assistance and grant funding, and have a lot of very good examples in place where people started with a small idea and today they have a much larger business with the help of development finance institutions. And this is also part of what our members are doing, that in the further process, when later stage financing is required, that they always then work together with local banks. So also getting local banks actively into the financing, and by doing that also provide the technical assistance to the banks in order to better understand what is needed in order to promote much more entrepreneurial development, especially in the context of Africa. There's a role to play.
Thank you very much. And to the audience, thank you for staying with us this long. We appreciate it. You could, if you have many more questions, you could, shoot us a question. I'll be glad to, pass it along to Bruno. And, it's been an interesting time today. Thank you for watching, and enjoy the rest of your evening or afternoon. Have a good day. Bye-bye, everybody.
Okay. Bye-bye.
Bye.